Hey everyone, welcome back to my channel once again, and today we'll be talking about that one particular stock which, according to my analysis and in my opinion, is a really stable investment. And before we go further into deeper analysis, I would like to make one thing clear, as always, that I am not a financial advisor and you guys must do your own research, and please be careful with whatever money you put in any kind of investment. So without further ado, let's dive into it. So let's quickly have a glance at the company's business. What is the company about before we dig deeper into the fundamental analysis? So today we are talking about MTU Aero Engines, and as the name of the company, MTU Aero Engines, it's defines the company's business actually as well. So MTU Aero Engines is Germany's leading engine manufacturer, and the company engages in the design, development, manufacture, marketing, and support of commercial and military aircraft engines. So, apart from making engines for commercial purposes and military purposes, they are also heavily involved in maintenance and services. So, maintenance, repair, and overhaul (MRO). And this is an important factor to consider because this we will see further in the video as well that a huge amount of revenue is coming for this industry, for this particular company, from maintenance and services as well. And since we are talking about maintenance and services, MTU has anticipated that in 2020 spare part sales for commercial engines will increase by a percentage in the mid to high single digits, and this again is an extended source for revenue. So since we are talking about the company's revenue and the future revenue, I as an investor, I'm really not worried about the company's future revenue. The first point being is the company's diversified source of income or revenue. But before that, worth noticing here is that the company was able to increase its revenue by 13% in the first quarter 2020 when compared to the first quarter of 2019, and considering the current circumstances, that is actually a huge plus point for the company. Okay, so the company has three major segments as we discussed before. So the first segment, the OEM commercial, that means the original equipment manufacturer commercial. That means the company was able to generate a revenue of 399 million euros by selling commercial engines, and that was an increase of 4% when compared to 2019's revenue. In from the military segment, it actually decreased by 7%, but the major point here is the revenue generated by maintenance and services, and that is an increase of 21%. And that also is a huge part of the company's total revenue, in this case around 60%. This is what I'm talking about, that even in such circumstances when the demand is low, they would still be managing to get their revenue running from the services and the maintenance what they are providing for their engines. And the second reason being that the company is hugely funded by investors and supported by the German government for the upcoming projects. And guys, these are not short-term projects, these are long-term projects. For instance, until 2050, MTU is planning to design engines with reduced both CO2 and NO pollutant emissions. So all in all, the company does have huge upcoming projects, and with its diversified source of revenue, the revenue will keep flowing in and will be steadily increasing like it happened in the past years, if not with a higher margin. And then there is another positive factor making to the list of positive points for this company and making me interested as an investor in this company is that the company itself is well aware about the market recovery situation. The company is making basic assumptions and is well aware that the air traffic demand back in 2019 might come to the same levels in 2022, and they're also considering the risk factors involved, that there might be no vaccine available until 2021, and this global recession might last longer than 2021. And this is what I like about this business, that they are making strategies involving the risk management, unlike some other businesses out there which are really optimistic about the economy. It is not wrong, guys, but considering the crisis, the business models should be considering worst case scenario, and this is what MTU Aero Engines is doing right now. Okay, so now since we are done with looking into the basics of the business, how the business is operating as an investor, now let's dig a bit deeper into the fundamentals of the company and looking into its financials. So the company is MTU Aero Engines, as you already know, and the ticker is MTX.F. F is because the company is trading at Frankfurt Stock Exchange. So the stock price is 156.25 euros. This is the price at the time when I'm making this video. Market capitalization currently is sitting at 8.2 billion euros. Now let's check the income statement. So the total revenue is 4.6 billion euros in trailing 12-month period. The gross profit is 904 million euros. The operating income, not loss since it's positive, is around 660 million euros. And then the two most important margins which I always consider are the gross margin and the operating margin, which is 20% and 14.2% respectively. So any gross margin between 15 to 20% or above, I consider it as a healthy margin as an investor. And operating margin is quite low because the average operating margin for a good industry should be around 20%. But considering the current circumstances, it is not that bad as well. And then we jump onto the net income. So the net income is around 478 million euros. Remember this amount because this we will consider to calculate how much return we might get on our investment and if this is a good value investment. Okay, before we jump onto the balance sheet analysis, I just want to point out one thing to you guys. If you see here, the gross profit had been increasing steadily for this company over the past years, and so is the operating expenses and operating profit. This means that they had been handling their margins quite steadily, and this is what you should also check or see when you are looking into the income statement. Okay, so now let's have a quick look at the balance sheet. So by the way, guys, I have taken these numbers from Yahoo Finance, so in case you just want to check yourself, you can have a look there as well. So cash and cash equivalents are around 180 million euros. Total current assets are worth 3.6 billion euros. Total assets are sitting at 7.7 billion euros. Total current liabilities are worth 3.2 billion euros and total liabilities are 5.3 billion euros, which brings us to our total assets versus total liabilities ratio is around 1.45. And I have mentioned this many times in my videos before that any ratio above 1 means good ratio. That means they will be able to pay off their liabilities more than one time. Total stockholders equity is 2.335 billion euros. And before we go further, I just want to point out one more thing to you guys. You must always have a look at the stockholders equity and see that this should be increasing. This simply means that the company's assets are increasing at a much faster rate as compared to their liabilities. Okay, so coming back to our ratios, the current ratio is 1.12, and in these circumstances I would strongly look at the current ratio because this means that if they have to pay off their current liabilities, that means the liabilities which they owe for the next 12 months, they can really pay it off and still will be left with some current assets. So this ratio must definitely be higher than 1 in this scenario because these are the industries which are going to be strongly affected by the recession. So debt to equity ratio is lower than 0.45. So this simply means that the assets are funded by equity instead of debt. In other words, we can say that the lower this ratio is, the less risky the business is because the business has low debts. Moving on to our next ratio, which is price to earnings ratio, which is actually at 17.61 now. And this is one of the ratios which I also consider when I am evaluating a business. So honestly, I prefer businesses which have price to earnings ratio lower than 20. So this is suiting my conditions and this is close to 20, but I will still consider this considering the other factors which are involved in this business. So like I said before many times, I don't take only one ratio or one multiple as a deciding factor. I look into the whole business. So anyways, so moving on to our next ratio, which is the beta ratio, and as you can see the current ratio is 0.8. So what it actually means, it simply means that when this ratio is less than 1 for any particular stock, then the stock price of that stock is less volatile in relation with the overall market, or let's say it is not deviating from the market. And this is what actually I'm looking for. So when I'm looking for a stable business, I'm looking for its stability in every field: income, revenue, and even the stock price. So as you might have seen in the past few weeks that some stocks are moving by huge margins, by 20%, 50%. Yes, these stocks might give you huge returns, but on the other hand, they also are really risky. So right now we are talking about a stable business with decent returns, but in long term. So I definitely have no problems when the stock price is not moving by huge margins until it's moving in a positive direction. And I'm pretty comfortable in holding this stock for a longer term, 3 years, 4 years, 5 years until I get my returns.
So moving on to our cash flow statement, here we have net cash by operating activities, which is positive 831 million euros. And this means that the actual operations are making profit. And then the free cash flow, which is 380 million euros. That means this is the amount of money which they can actually use and invest back into the business. So just one more thing I would like to show you guys. So if you see that acquisition of investments right here or purchase of investments have reduced from last year, and also it's actually less than as compared to 2018. So what purchase of investment means, that means the money is being invested in some other things to get returns from these investments in the coming years, which has reduced. But this is not a bad thing, because if you see here that they are investing more in property and plant and equipment. So as we already saw before that the company has upcoming projects, the company is actually putting the money and investing money into its own business and buying property or plants or equipments, or supporting R&D with this money. So this is what I like about this business, that they are very well aware about their priorities and when and where to invest money or investing back into the business. And then there is another plus point in this business. If you see here, the free cash flow is increasing over the years. So that also means that they will be having free cash at the end of the day to invest back into the business to fuel up those upcoming projects which we already saw before.
And last but not the least, one of the other attractive numbers for many investors out there, the dividend yield rate. Yes, it is around 2.3%. I know it's not that high, but to be honest, guys, the companies which are promising around 9%, 8% dividend yields, they might be cutting on their dividends soon because they are most probably on huge debts and they won't be able to give out such dividend yields. But instead, companies like this, which are giving or promising around 2 to 3%. This is not that high. That means they won't be cutting on their dividends anytime soon. And that also means that they will be continuing or increasing when the situation recovers. And let's come to the numbers game. So just to let you guys know that this is just one of the approach or one of the methods what I prefer or what I do to evaluate a company. Now my evaluation scheme or method do change depending on different scenarios, different companies, but this is one of the most basic ways what I usually follow. And just to let you know one more thing, that different investors have different way of analyzing or evaluating the company. So you should do your own due diligence. Anyways, so market capitalization right now is 8.2 billion euros and the trailing 5-year average PE ratio is around 20, which gives me a reflected earnings of 410 million euros. What I did to get this number right here is just simply dividing the current market cap by the trailing 5-year average PE ratio, which gave me the current earnings reflected by this business right now. And the current earnings, which we already saw from the Excel file or from the Yahoo Finance, you guys can have a look as well, is around 478 million euros. Now, this means that if I invest in this business right now, I'm just expecting that the earnings in the future will be more or around 410 million euros for sure. And that's already been proven that the current earnings is around 478 million euros, which is above my reflected earnings calculation. And that makes this as a good investment from my point of view. And that also means that I might have a return of around 85%.
One more point to be added here, as we already saw that the trailing 5-year average PE ratio is 20 and the current PE ratio of this stock is 17.61, which gives us one additional reason to consider. And this actually tells us that currently this stock is undervalued when we are comparing it with its past PE ratio. And this also means that the price of the stock is currently less as compared to its earnings in comparison with its past average PE ratio.
The second method, what many investors are doing, is that they are calculating the intrinsic value of the stock. Now, I won't go deeper into the calculation of intrinsic value because this might take another 10 to 15 minutes. If you guys are interested in knowing how to calculate the intrinsic value of a particular stock, please leave a comment in the comment section down below and I will make a video on that. But for now, this is the current intrinsic value. It is around 220 euros and you can find it yourself as well. So the stock price is currently, like we already saw, is sitting at 156 euros, which again tells me that this stock is right now at a massive sell off. All the indicators are indicating towards one thing, that the stock is currently undervalued and this is a good buy. but this is again just my analysis, this is my approach, and this is how I'm evaluating this stock right now. And to be honest guys, this business is a really good business
and the earnings are quite steady for this business as well, unlike the other businesses in the airline industry where the companies are at the verge of bankruptcy or are being bailed out by the government. This is not happening with this company, and even with the decrease in demand of their products, in this case engines, they still have other source of revenues like maintenance and services, and this segment is playing a huge part in their revenue, and that's why the company won't be affected largely by the current circumstances. So currently I'm holding just 2 shares of MTU Aero Engines at 156 euros. I would be acquiring a good position into this company if it goes to 140 or below, and since it has the capability to reach 270 or 280 euros, I have no problems in holding this stock for a longer period of time until the stock reaches that position or even higher. So that's my verdict guys. According to me and according to my analysis, I value this stock as an undervalued stock, and this stock is at a decent value.
And that's it for today guys. I really hope that you did like this video, and in case you did, then please hit that like button, because then it really helps me promote this channel to the audiences out there who might get some benefit out of this. And if you haven't subscribed to this channel yet, then please do subscribe, and also don't forget to hit that notification bell icon, because then you will get the latest updates of my upcoming videos. Okay, maybe that's what you might not need, but I still recommend it. So I hope I will see you in the next one. Till then, ciao.